Hello, dear traders. The early trading hours of Wednesday are hardly different from those of Tuesday. In Australia, the market indicator climbed to its highest level in almost 7 months. This surge came mainly due to an increase in the shares of energy and the mining companies. The Japanese stock market, on the contrary, extended the losses of the previous 3 sessions, and the Wall Street stocks closed lower. During the Asian session, US stock futures show a steady bearish movement. The main factors behind investors' restrained behavior are still the same: China's unrest over COVID lockdowns and the Wednesday speech of Fed Chair Jerome Powell at the Brookings Institution. However, the influence of these events on the markets will be completely different on the final day of November. In China, the local authorities are trying to maintain the zero-COVID policy and stop mass protests at the same time. They stressed at a press conference yesterday that lockdowns will be lifted as soon as possible. Meanwhile, business activity in the manufacturing and the services sectors in China has declined at the fastest pace since April. It's also clear that easing restrictions may not be enough to prevent further economic turmoil. Such uncertainty is making investors even more concerned. Meanwhile, Jerome Powell's Wednesday speech on the country should throw some light on the future of rate hikes by the US Central Bank. While Powell will be talking about the prospects for the US economy and the labor market, investors will be looking for any clues in his comments about the regulator's future stance on the monetary policy. This week, some senior US central bankers have already given hawkish comments on the interest rates. They warned of the possibility of a further rate hikes next year as inflation in the country remains stubbornly high. The interest rate has been lifted to the range of 3.75 to 4% since March. James Bullard, the president of the Federal Reserve Bank of St. Louis, said earlier that the Fed should raise interest rates to the range of 5 to 7%. At the same time, New York Federal Reserve Bank President John Williams believes the regulator should continue hiking rates in 2023. Two-thirds of investors now expect the Fed to slow the pace of tightening to 50 basis points in December. The greenback somewhat stabilized on a hawkish comments of a senior US central bankers and expectations of a Powell's interview. The US dollar index added more than 1% in the previous 3 sessions. On a Wednesday, it stayed above 106.4 points against the basket of 6 major currencies. An increase in the US Treasury yields provided additional support to the greenback today, which is usually followed by a sell-off of risk assets and a rise in demand for safe haven assets. Active trading in the market will begin in the middle of the North American session after experts digest the Fed chair's comments and the macro data from the United States. In addition, the Beige Book, a review of the current economic conditions across the 12 Federal Reserve districts, is set to be published today. Ahead of these events, the US dollar index is consolidating in a fairly narrow range of 106.40 and 106.80. The dollar-yen pair is staying in the red zone for the 3rd straight day. On a Wednesday, the quote rebounded from the 138.50 low and then strengthened by a 0.25% against the dollar. During the Asian session, the pair traded at 138.70. Notably, the quote has limited downside potential as it's moving near the oversold range of 138.30 and 138.90. If sentiment remains bearish after reaching the 136.90 support, the yen may head towards the top of early August in the area of 135.60 and then fall to the August low of 130.40. Today, the yen also received support from the Bank of Japan report that showed an increase in inflationary pressure in the country's various economic sectors. In addition, the currency is still supported by investors' hopes that the Japanese regulator will review its monetary policy. The thing is that the Bank of Japan's boss, Haruhiko Kuroda, insisted on the importance of a loose monetary policy to boost wages. He also recently said that tightening the labor market would help drive up wages ahead. In other words, there is a chance that the regulator curtails its stimulus program and becomes more hawkish. As a reminder, inflation in the country has already accelerated to 40-year highs and came in at 3.6% in October. In the meantime, inflationary pressure eased in Australia. Consumer prices in the country decreased to 6.9% in October from 7.3% in September, which instills optimism. Moreover, the Reserve Bank of Australia decided to slow the pace of rate hikes. True, consumer prices are still very high and far from the Reserve Bank of Australia's target of 2 and 3%. It's clear that the recent decrease in inflation came thanks to the dovish decision of the RBA. Above all else, the Australian regulator is expected to again raise the interest rate by 25 basis points next week. In the light of a slowdown in inflation, the Australian dollar came under pressure and its further direction now depends on its American counterpart. On Wednesday, the AUD-USD pair traded higher in the range of 0.6671 and 0.6733. Extending yesterday's uptrend, the pair flirted with a 0.6700 mark. During the Asian session, the quote were seen near the area of 0.6728. Notably, the pair's upside momentum was underpinned by the cautious optimism linked to China's COVID conditions. At the same time, AUD-USD fails to justify downbeat Australia's inflation data as well as disappointing activity figures from China. Today, the Aussie dollar is likely to remain bearish as the markets prepare for hawkish statements from Fed Chair Powell. And this has been our review of the Asian session. Today, investors will focus on the ADP data for November, US third quarter GDP, and of course, the Fed boss speech. See you in our next video. Bye.